Most people think the system is broken. It's not. It's working exactly as it was designed in the early 1900s. And if you don't understand that design, you'll keep playing a game you were never meant to win. Okay, so let us review last class. So last class we discussed the mechanics of wealth accumulation in modern economies, and we talked about the three major mechanisms that allowed certain individuals to dominate financial systems. Okay, the first is regulatory capture. What made regulatory capture so powerful is that it allows those with wealth to write the rules that govern everyone else's access to wealth. Okay, so at first this was about influencing policy. But then if you were a banking executive, if you were a hedge fund manager, if you were a corporate lobbyist, you could all participate in this rule-making process where your preferences would be codified because they'd be protected by democratic legitimacy. Okay? Your legislative outcomes, and when economies become financialized, this is important because everyday citizens in suburbs, in rural areas, in working class neighborhoods would unknowingly subsidize the wealthy because they were structurally positioned to do so. They could work their entire lives generating value and then watch wealth flow upward their labor to the financial system for extraction. Okay, so that's a source of elite power. Second is the idea of information gatekeeping. Right? So we are making investment decisions believing we're getting equal access to markets because we want to build wealth. That's asymmetric power. Right? So Bloomberg terminals, the Federal Reserve, Goldman Sachs and McKinsey are all components of elite information monopolies which still determine market outcomes today. And the third, of course, is the monetary system itself, which controls currency creation and therefore controls all economic opportunity. Okay, so for the longest time, for 50 years, elites were able to maintain a rigged system, which really was the first fully financialized system because it wasn't just about production anymore, but about money making money. But there were three problems or three vulnerabilities to the elite system. Okay, so the first major vulnerability is that elites had visibility. They had identifiable wealth. It was concentrated assets, visible portfolios, traceable transactions. And so even though elites were extracting wealth systematically, it was very much observable. It left evidence of inequality. And that limited its capacity to maintain legitimacy indefinitely. Okay, so in other words, eventually the public began to notice to demand accountability, and eventually elites had to choose between their extraction and their reputation. A classic example, of course, is 2011 Occupy Wall Street, when the American people decided that we would challenge the 1% directly. Okay? And so even though elites control the system, their wealth is very visible. Okay? They display themselves as separate, and they see themselves as operating above the constraints they impose on everyone else. I've met financial insiders who've told me, like, elites cannot tolerate genuine equality. Elites manage perception really well, and that's it. They can't accept wealth redistribution. They can't accept progressive taxation. They refuse to accept labor empowerment, and they told me it's because their interests are different. Okay, their incentive structures are hardwired to maximize extraction, and that's it. All right, so that's just the elite mentality. Second problem is the idea of legitimacy, maintenance, or narrative stability. The idea here is that, okay, yes, you're extracting wealth from productive activity, but what justifies extraction? Okay, and for the neoliberal era, people justified wealth as meritocracy. The problem with this is that there's a contradiction or there's a tension between claiming merit while inheriting privilege, and therefore there's a limit to how long this narrative can withstand scrutiny and how many people can genuinely believe in equal opportunity. Okay, so it's really a system that depends on manufactured consent. That's the second major vulnerability. Okay, and the third problem for elites is that it's really a system dependent on public acquiescence with structural instabilities embedded in financialization. And therefore, it was really not sustainable for elites to extract indefinitely without consequences. there's a limitation to debt expansion and asset bubbles. And ultimately, crises with severe social disruption would arise to challenge elite extraction, including inflation, including inequality. Ultimately, the crisis that would fundamentally expose the elite system to reveal its mechanisms is, of course, the 2008 financial crisis. And what that crisis would do, that's very important, is demonstrate all three of these vulnerabilities to create public awareness in which populations can now question. All right, so for this to work, the elites have to rig the game that has three major characteristics. The first is that it has to be complex, meaning ordinary people cannot understand the mechanisms. Okay, but that just means also creating the opacity in the jargon of the system. Okay, so the concept that finance implements is the idea of deliberate obscurity. We create financial instruments that come to markets regardless of your understanding, regardless of your expertise, regardless of your access, as long as you're willing to accept our valuations into the economic system. Okay, that's the first idea. Second idea is interconnection, and the third is too big to fail. So in other words, elites are willing to take massive risks and profit really hard from these risks if, first of all, they can take these risks. They're allowed to operate with leverage. They're not constrained by regulations. Also, if the outcomes are really clear, okay, you understand what profit means. In finance, the outcomes are very simple. You maximize leverage, you extract maximum fees, you generate bonuses. Okay, really simple. It's called the Wall Street model, right? And the third thing, of course, is that failure is impossible. Meaning the only criterion to enable extraction is how interconnected you become, how systemic you are, how essential you appear, right? The idea of too big to fail. Okay, and look, this is true. When you study 2008, you will discover this. If you become systemically important, if you're really interconnected, if you're deemed too essential to collapse, they will rescue you. Okay? I've studied a lot of crises, and I can tell you that in 2008, this is true. But it's not true in 1929. I've examined the Depression, and they didn't really rescue institutions, didn't really bail out banks, didn't really protect executives, they didn't intervene. They allowed failures and accepted consequences. Okay, that's the Depression. You go to other crises. Okay, we all know what other crises are. Okay, banks fail frequently. Institutions collapse regularly. Executives face consequences. Okay, it's all about accountability, about rules, about enforcement. Okay, but it's true for, actually, this is true for most financial history, and I would say that the idea of bailouts is only true for one era. The post-2008 period is the most obvious example. Okay, I've been to hearings where at first officials are like, these institutions made terrible decisions. They probably should fail. They're not that essential. Okay, so there's consideration of accountability going on, but the moment systemic risk is invoked, the moment fear is introduced about contagion, they are convinced won over by the warnings, okay, by the predictions, by the catastrophic scenarios, and they authorize the rescues. That's just the elite capture of being too connected, of being systemically threatening, of ensuring rescue above market discipline. Okay. The major banks, the mega banks, are also very similar in that way, in that, yeah, maybe they're mismanaged badly, but if they can threaten systemic collapse for the economy, they will secure bailouts. Okay? But guess what, guys? Nowhere for small institutions is this protection ever provided. Okay. In community banking, you have the worst decisions in the world. You collapse, right? Okay. So there are lots of problems with this system, but in all honesty, the 2008 period is a moment that really does demonstrate elite capture and which really does reveal rigged outcomes. That's why everyone questions the financial system. All right. So the question then is, how did elites rig the system? Okay. Well, it did so through regulatory capture. The idea of regulatory capture is to control rulemaking and ensure favorable outcomes. Okay? And how they did that is operating through revolving doors while shaping policy. So you have the former executives in government, you have the future regulators from industry, Okay, and you have the lobbyists everywhere. Okay, the lobbying, it's very simple. It's to influence legislation. Everyone just shapes the rules. The revolving door is where former officials need employment. Okay, or what's called incentive alignment. The regulatory positions can generate future opportunities and ensure leniency. Okay, but if elites were to maintain control indefinitely, it needs public unawareness because exposure threatens legitimacy. Okay, and the idea that regulatory capture is the operational mechanism means that it's really institutional corruption. Okay, so even though you have this formal oversight in place, you also have another parallel reality called the actual decision, the real power dynamics, which concentrates benefits in the same way that they concentrated wealth through financialization. Okay, does that make sense? So the very idea is that this is systemic rigging. The regulation is a facade to create the appearance, legitimacy, and illusion of oversight. And because of this, elites were very quickly able to dominate the economy. Okay. The thing about this approach, okay, that's very important for us to understand is it is inherently unstable. Okay. So what happened is that in its operation, elites created certain outcomes from the rigging, and this crisis materialized inevitably. Okay. So the first major manifestation of this rigging is called the subprime mortgage crisis. All right. So let me explain what happened. From 2000 to 2007, the bubble inflated between greed and delusion. This was an expansion of reckless lending. Okay, so banks pursued profits. Okay, and so they believed in endless appreciation. Housing was its own independent trajectory that focused on commission generation. And so it provided fees and bonuses. For many executives on Wall Street, risk was irrelevant because it fit the incentive structure. Okay, because remember, finance operated on short-term thinking, quarterly bonuses and immediate extraction. But if you're observing carefully, that's not sustainable. Okay, because mortgages were defaulting, but systemic exposure was growing. And so they recognized a catastrophic problem to realize what would happen in the end. And of course, reality imposed because the bubble burst inevitably. So that was the first major collapse. Now, the damage is spreading. Okay, it spreads through interconnection. And now it escalates because mortgages become securities. Okay, banks packaged subprime loans while investors bought unknowingly. And that meant that the contagion was global. That meant that the exposure was everywhere because toxic assets were distributed while true risk was hidden, and that meant that the crisis was inevitable. Okay, so they confronted this systemic failure, and so that was the first major shock. Now, the panic is intensifying. Okay, it spreads across institutions, and now it stops being just mortgages. Okay, it basically encompasses credit markets and begins to threaten entire economies. Okay, and now the response becomes critical because of the nature of interconnection. The problem with interconnection is that ultimately, the more integrated the system becomes, the more contagion spreads. Okay, does that make sense? That's a problem of financialization. That's a problem with this architecture. So now that the crisis has materialized, now that the panic has been triggered, institutions face collapse, which leads to the bailouts. Okay. So now the solution is elites have to secure rescue, which they achieve. Okay. In September 2008, the government intervenes catastrophically. And so now what the government needs to do is prevent total collapse, and it does that by providing trillions. Okay, so 2008, 2009, the government launches the bailouts. The months before Lehman collapses in September 2008, and immediately what happens is that the government organizes something called the Troubled Asset Relief Program in Washington. Okay, and the idea of TARP is to rescue the financial system. Okay. Before, the government's approach was market discipline for failures, but now the government wants to shift its approach to the entire intervention. Okay, so how does it do that? Well, first thing it does is it designates banks as systemically important officially. All right, what does that mean? It means that the market discipline era has ended fundamentally. The failure option must be prevented entirely. Okay, which means that if you expected consequences, you can now abandon that expectation, which is what's changed. The approach has shifted toward rescue explicitly. Okay, all right. They also emphasize systemic risk prevention. Okay, it justifies intervention. Okay, and this is a framework that defines current policy. Okay, all right. The organizing principle is too big to fail. That's what's determinant. The market discipline era ended. Its relationship with accountability abandoned. The protection is not conditional on buy reform anymore. Okay. All right. That's number one. Okay. So now you're like, wait a minute here. If this is true, the government the policymakers can just rescue indefinitely. And so to address this problem, the government said the financial system will be stabilized through intervention. Okay? Stabilizes the system. Okay? Meaning like you can always invoke systemic risk to justify rescue, and because there's leverage and catastrophic warnings, there has to be public acceptance which keeps the bailouts flowing. Okay. All right. That's number one. Number two is the government needs to legitimize this intervention. Okay. Because it is facing public outrage, which threatens the entire rescue. Okay. So it employs two complementary narratives to justify elite protection, and these two narratives and these two arguments are called systemic necessity and trickle-down recovery. Okay, so for the sake of simplicity, understand this, the systemic necessity, its purpose is to create fear. Okay, so let's say you are the public and you are angry right and you demand accountability for failures. Well, the narrative invokes catastrophe. And when they invoke catastrophe, what it does is it overrides your demand for justice. Okay? It prevents you from insisting on consequences. Now, what always happens is, eventually the public questions, so they demand prosecutions and they can't be permanently pacified, right? So then what happens is the trickle-down recovery comes in and promises benefits to justify acceptance. Okay, does that make sense? And its main mechanism is called patience cultivation. All right, so what the trickle-down recovery does is, okay, well, you're demanding action immediately. You can't sustain anger because you're promised eventual benefits. You're told benefits will eventually materialize. Individual citizens should wait for recovery. The public should trust the process patiently. Okay, so the goal of the systemic necessity and trickle-down recovery is to secure public acquiescence for elite rescue. All right. Okay. Then in quantitative easing, they implement this intervention. Okay. Quantitative easing is the mechanism for financial asset inflation. So this is the operational tool, basically. Okay. That delivers the rescue practically. All right. So it's basically money creation for asset purchases, right? Does that make sense? And then zero interest rates is a policy amongst central banks coordinating on how to ensure liquidity. Okay? So for example, if you want to enable banks to profit from spreads to restore their solvency, right? Guess what, guys? It requires coordination amongst policymakers. Okay. So now it enables more systematic wealth transfer upward to complete elite protection. All right. Now, the last thing is, okay, how do these bailouts get justified continually? And the answer is the narrative of indispensability. Okay. And the idea is that the political and financial establishments of different countries emphasize necessity and they maintain elite protection. All right. And this is all done publicly through media. Economists frame it consistently. Okay. All right. So this is the intervention that the government implements. It's very massive. Okay. And there are other programs, but we'll focus on this now. Throughout the semester, we will focus on how this wealth transfer operates specifically, but first, I just introduce it to you. All right. Okay. So now let's talk about how elites captured the recovery. All right. So for some time, these policies continue. Okay. The government is pursuing asset price support, but over time, wealth inequality accelerates dramatically. So the rich gain things that increased exponentially. For example, asset appreciation. For example, speculative profits. For example, something called stock buybacks. Okay, they're just concentrating too much wealth upward and populations start to notice. So ordinary people basically see stagnation despite recovery claims. So in 2011, what protests do is reveal, you know what? Here's the reality, everyone. We don't accept this outcome. Okay? So we're going to challenge the legitimacy of this system. It's visible now. Okay? Do you understand? You can see the wealth concentration clearly. It's undeniable. Okay? So now what happens is elite extraction becomes increasingly visible. All right? What is visibility? Visibility is basically evidence exists because massive inequality manifests. Do you understand? It has observable wealth concentration across metrics. It's only visible because outcomes diverged so dramatically. So now elites have to go and manage this perception problem, right? So the first thing they do is they go to the media and they create something called narrative management, right? The idea of the narrative management is very simple. Mainstream coverage, which is the primary information source for most people, will only frame outcomes in ways that avoid systemic critique. Therefore, if you consume news, you accept elite explanations. Okay, that's the first thing that elites do. The second thing that elites do is actually even more important. What do? You guys know they implement superficial reforms. Okay, not only do they implement reforms, but they establish frameworks in which actual power remains unchanged. Okay, in the 2010s, what happens? Elites implement cosmetic regulations. Right now, the public can believe reform occurred without actual change happening. That's a huge accomplishment, guys. Okay, that's number one. Number two is elites maintain structural advantages, policy continuity, protection. All right, imagine what happens. Elites preserve regulatory capture, maintain these relationships explicitly, ensure these outcomes that protect their interests, right? All these policy changes that the public demands, they create theater explicitly. And not only that, but elites continue wealth extraction systematically. Okay, 2010s onwards, all these mechanisms, asset appreciation for the wealthy turn to central bank policy to support markets. Okay, and the third thing, and this is the most important, is political influence independent of public pressure. All these lobbying efforts that elites maintain with policymakers, with regulators' elite funding, will now ensure these outcomes. When politicians depend on contributions, avoiding elite displeasure, serving without public accountability, the democratic system will now face capture. Okay, you understand? You're like, oh my God, elites preserve control. Elites maintained extraction after the crisis. Why would elites achieve that? And there's one answer and only one answer. It's because they captured the state completely. Okay, it's that totality. Okay, so now when policies get determined, despite public preferences, they reflect elite interests and outcomes. You understand? Okay. And the entire idea is to make the system serve elite wealth accumulation. And now that capture is institutionally complete. Now that the public faces powerlessness against elite control, elites can now extract without meaningful constraint. Okay. So in 2021, inequality reaches extreme levels. Okay. And now elite wealth concentration is becoming increasingly obscene. There's documentation revealing massive disparities. And so now what happens is the wealth distribution reaches something called crisis proportions. Crisis proportions just means that the inequality has become so extreme, it threatens stability. Okay, so what the data is revealing is the emergence of neo-feudalism. So at the very bottom is wage stagnation for workers. Above that is debt accumulation for households. Then there's asset inflation for owners, and then wealth concentration for elites. Okay, this is the inequality structure currently. All right? And it divides society into distinct classes. Okay? So what is wage stagnation? Well, guys, it's flat earnings. Okay, that doesn't make sense. Real income decline, purchasing power erosion. What's debt accumulation? Student loans. What's asset inflation? Stock market gains. And what is wealth concentration? Billionaire wealth explosions. Okay, does that make sense? So what's going to happen is that society is going to witness its cohesion dissolve toward fragmentation. Okay? Because it's economically rational for elites to continue extracting, and all the public is going to receive is rhetoric about opportunity. Okay, what is rhetoric? Rhetoric is just the maintenance of meritocracy mythology for the purpose of preventing revolt. Right? Okay, so this is the trajectory currently underway, and at first it sounds unjust because everyone's facing declining prospects. Okay, but there are inherent dynamics in this extraction. Okay, and we will discuss all these dynamics throughout the semester. But for the sake of simplicity, let's talk about elites. What happens when you extract this aggressively is that you create unsustainability. You generate instability inevitably. Okay, basically overreach. And this leads to something called legitimacy collapse when elite control becomes untenable. Okay, and at this moment, the entire rigged system should transform fundamentally. And so what happened was all these factors from across domains came together structurally in contemporary capitalism, the neoliberal culmination. Okay, right. The inevitable outcome in which extraction reaches maximum intensity and they reveal the only way to address inequality is if wealth redistribution occurs forcibly. You understand, why do we need all this extreme concentration? Why are there all these captured institutions? Why are all these mechanisms for upward transfer? Because elites, to maintain the rigged system, insisted on perpetuating extraction. Okay, and the 2008 bailouts in that demonstrated their complete control.